Welcome to the Mystery to Mastery podcast with your host, Keisha Shepard, where ideas become action and stories inspire growth. Through powerful conversations with founders, innovators, and industry leaders, we explore the journeys behind success, the lessons learned along the way, and the strategies shaping the future. Join us as we turn insight into impact and transform mystery into mastery. All right, it's time for a quick word from our sponsors. Number one, we have HBCU by association. This is so exciting because we are launching our website now, and you can get online and network with other HBCU alumni. So go online, hbcubyAssociation.com. We're there to work, learn, and play. Looking forward to seeing you there. Hello, and welcome to the Mystery to Mastery podcast. Today, we're going to be discussing real estate. Real estate is expensive. The prices, the competition, all of that is making owners wonder if they will ever be able to be on the path to ownership and investment. But today, we have back one of our favorite guests, Ronald Willis, with his mentee, Shepard Solomon. And there, we're going to be discussing the do's and the don'ts of real estate, different ways to invest and get funding for your projects, and more. So with that, I'm going to welcome my guests.
My name is Ronald Willis again. I have 10 properties. I started out with one property, and over a period of 20 years, I accumulated 12 properties. And I just want to say that it has been profitable, it has been a struggle, it has been a love of labor, and it worked for me. My mother was a landlady. She lived in the same house for 60 years, and her big deal was she inherited from her mother, and what she did, my mother did, was use rooms in her home to rent to tenants. And that was her way of building a situation where she could buy better windows, indoor plumbing, gas furnaces, etc., etc. That's what she did. Her son, me, I bought my first home in Parkside Garden. And after 2 years, within 2 years, I bought the second home where I am now. And then I used leverage, meaning equity, to buy the third, fourth, fifth, and so on. About 10 years ago, I sold 2 of the 12 properties for a phenomenal profit, and I used much of that profit to pay off the other 10. And so that was an example of leverage, creative financing, which is nothing new. It's nothing new to use what you have to get what you want. So I think my audience would truly understand the definition of equity in a home, how it's evaluated by the banks, the real estate agents, and how they can help you understand how to use that invisible money, I call it also invisible money, to buy the second, third, fourth, fifth home or enterprise. When I say enterprise, you may buy a business. And so equity is super important. I can't overestimate that. All billionaires, millionaires, trillionaires use equity to advance their business. It's not a new concept. So if you know how to use the equity, that's a part of the creative financing strategy to become financially independent and wealthy. So,
What? Mm-hmm.
Go ahead. I can. Yes.
So, I guess for me, I need to go back to the basics of this.
Okay.
If you were to define creative funding, we talked about equity and things like that. I'm very familiar with like net worth more. If you were going to define that, what would creative funding be?
Well, it would be able to use certain financial tools, such as your credit card. I can speak from personal experience that one of my properties on Pioneer Drive, it was for $45,000, this particular semi-detached home. So I negotiated, first of all, the house from 75 to 45. There's ways I did that. But what I did was I had several credit cards, great standing with my credit cards. So one credit card was $20,000, another one was $20,000. So I joined the two, convinced the bank that I wanted to buy the house from that I joined two credit cards to buy that house. And I had $5,000 of my own money. And so that's an example of creative financing. I've never used hard money. I think, Mr. Shepard, have you ever used hard money to buy a house or for purpose?
When a private lending company is basically lending money, and they lend it money because they see an untapped market, an untapped home value into the home. They're only going to do it for homes that they see is going to basically appreciate highly, especially after repair.
Okay.
So hard money lenders will give money to get the home. Most of the time, this home is very distressed. It's not renovated yet. And they're going to also supply money for renovations. So example, say you have $150,000 for the home. They want the asking price is that $50,000 in repairs, but the ARV, the after repair value is around $300,000. Hard money lenders will lend those things, and they're going to want information. They're going to want, hey, what type of area this is, the comps. They're going to want the work that needs to be done. Is it really risky? So it's a lot of work to really get hard money lenders involved, but they can help you out with a lot of things if you need it, especially if you're just trying to start out, and it really comes as cash. So the good thing about this with hard money lenders, it doesn't go on your credit report. So you can kind of get funding without having to get hit on the credit side. So that's really what hard money lending is. But with hard money lending, they have a lot of high terms and they're short-term loans. So most of the time, the interest rates are really high, around 12 to 15%, okay? Because the hard money lenders trying to get their money. And the length of the loan is usually less than 2 years. So people use hard money loans, new investors, just to get the property. And then what they do is after they get the property, they refinance that home. Then they pay back the hard money lender. And basically now they got a home with better terms. And a longer length of paying it and a lower monthly payment.
On a lot of TV shows that I watch, and they basically will go and say, this is my property that I want to renovate, and what I want to do is put money into it and then sell it at a much higher value than what it's sold for. And that's what the hard money lenders are looking for. They're looking to get a return on their investment. How much of a return are they looking for usually?
The hard money lenders, okay, so when you work with hard money, they kind of just want the loan back. They necessarily don't want to make money off the property. Now they'll have a lien on the home if you default on payments, which that's what they're banking on as well. Say if you, like I said, the first example, you put $150,000, the asking price is $150,000 for a distressed home. The renovation is around $60,000, but the after repair value is around $300,000. If that borrower does not pay those loans back to the hard money lender, the hard money lender can now get a lien on their home and take the home in foreclosure. But now they got a home for $300,000 that they can sell if they want to. But really, at the end of the day, the hard money lender just wants their money back plus the interest that they're getting from it. Because they're getting the short-term loans, they're not really taking a lot of risk. And they're not waiting for their money for a period of time. They're only waiting for less than 2 years. So that's kind of the strategy with hard money lenders.
Mystery AI is a proud sponsor of the Morgan STEM Expo, featuring OIC of America STEM Fest. This is such an exciting time. The event is going to be on September 26th from 10 a.m. to 3 p.m. We need volunteers, students, exhibitors, and sponsors. If you're interested, visit mysteryai.net/STEM. Just one more thing. I don't know where to find a hard money lender. Is this just a traditional bank or is it something different?
More private companies, and I'll tell new investors this, hard money lenders are mostly people who work with investors under the table. So I'll tell new investors, if you want to start out and invest in real estate, join investment clubs. join real estate investment clubs. This is where you can get the connections from people. You can get the knowledge, the mentorship, because you don't want to be in situations where you're trying to run real estate by yourself and you're making mistakes. Also, like I said, yeah, everybody wants to find a distressed home. Everybody want to find a good home in a good area that need work. Everybody's finding that. So if you're doing stuff by yourself, that means you kind of like in a saturated market. If you in investment networks, they know properties under the table that's not on market. So now you kind of decrease competition and you're working with the right people. So these hard money lenders are on these investment clubs groups because they know that real estate investors are going to be there, and they all kind of work together. And then you can build relationships with hard money lenders where you can keep doing deals with them over and over again. So that's kind of how it works.
The investment has to be well researched. It has to have the projection of a more than just a marginal profit initially. So the investigative group who looks at that piece of property has done an extreme amount of research on the demographics of that area. For instance, the city planners in all major cities, they have city planners in the government offices that know what is going on in their quadrant, their section of the city. If there's going to be a prison built, if there's going to be a drug house, I say drug house, but a rehabilitation facility for drug addicts and other addicts. They know if it's going to be a power plant, some segment of a power plant near that house. They'll know if it's going to be a highway built. So they study that area to make absolutely sure that this building is in the right place at the right time in history. So when they ask these investors to invest in this and to borrow from the hard money lender, that the predictability of success is not just medium, it should be a high rate of success. They shouldn't have to wait 5 to 10 years to receive a good profit.
He had mentioned that it was 2 years that they want their return. So it has to be a very quick flip. I guess I'm thinking of the show Flip House or something. This is very interesting. But what I'd like to do is kind of walk me through a deal and how that's set up. When it comes to traditional loans, I know I go into a bank, but in this situation, this feels more man to man, woman to woman, like hand to handshake. Like it's not the traditional route. So how do you actually go through making a deal in this situation?
Okay. I can respond first, Ronald. You can respond with your expertise after. So Keisha, great question. Like I was saying before, for new investors, I recommend going to investment clubs because they're showing properties all the time under the table, not ones on market. So you can find these good deals when you're networking with investors. And there's a lot of Facebook groups that have them. I believe Mara is an investment group in Maryland that you can go to, and they have meetings and you can see all this stuff. So they have it. So say if you go to an investment group on Facebook, you see a distressed property, they show it on their little profile and everything like that. Okay, I want to get involved in this. You contact the person who wants to get involved. All right. Now, yes, just like Mr. Willis was saying, do your due diligence. Research the area. What things are they building? How's the area? How is it trending? That's important because it's a lot of areas that are declining, some areas that are improving. So gentrifying, you have to see that too. Study kind of how things are changing. And then, you get a purchase agreement contract. After you do that, if you want to get hard money lending, you have to do your research on what repairs need to be done, as well as how much the repairs are going to cost. All right. So you get involved in that, get a contract set up. After that, if you want to do hard money lending, you're going to need to get a promissory note set up with them. They're going to have a contract set up with them where you got to pay them a certain amount of money and they're going to fund these deals for you. All
Are
right?
you doing this through a lawyer?
I will recommend doing that through a lawyer, because you're gonna need a lawyer for the title to transfer the deed in your name for that home anyway. And I recommend, they're probably gonna have their lawyers anyway, the hard money lender, to get a contract set up because they want to get protected. So all that's gonna be involved in that. And I'll tell real estate investors, get lawyers involved, title attorneys, so you make sure you're doing things the right way and nothing comes back to haunt you later. So after you get that, most of the time hard money lenders want you to put around 10% of your own money in the game, just to show you got a little skin in the game. One thing you can cover this is called a gap loan. All right, gap loans are basically loans that help you for that rest of the amount you need. Say they take care of the renovations, the hard money lender, and they also take care of 80% of the home value. The home purchase amount. 20% of that home purchase amount can be covered through a gap loan, probably like $20,000. So the main thing is you don't have to really pay anything yourself out your own pocket. That's the strategy you want. Okay, so you do that. Now, I think you was talking about, Akeisha, was the BRRRR method, which I'll explain a little bit that as well. You do your renovations. All right. After you do your renovations, some people, what they do is they rent it out for like a few months. Okay. They got to be a landlord in this situation. They're doing that not just to get the mortgage paid, but they're also doing it to show a history of that this property can rent out a certain amount each month. And I'm going to get to why that's important later. After they do that for a period of time, they can go to traditional bank, and they can get a thing called a DSCR loan, which is a debt service coverage ratio loan. So basically, you don't have to have W-2s and all this stuff for that. You can just basically have the property say, hey, this property rents out for this amount. This is going to bring you cash flow. Cover a loan for this. Banks are like, okay, I see your rent ledger. You've been renting this out for almost a year, 8 months. I see the consistency. I see the credibility. We can loan you probably 80% of the after repair value, which I said before was around $300,000 now. So now you're getting rented out. You're getting a loan for like $220,000. That $220,000, now what you do is, we were talking about before, Keisha, you pay the hard money lender back. You get it out of the way because those terms are really high. Now you in better terms now with a monthly payment is very, very cheap. You're also banking cash flow because your rent income is also high compared to what you're paying now. That means you're cash flowing. Plus, you can use extra money from that cash refinance to get another property. So that's called the BRRRR method. You buy it, you rehab, you rent, refinance, and then you repeat the same thing. So that's kind of how deals will go. And the most important, I would tell new investors, build your relationships with people because you want to work with good people.
Yes.
They want to work, so that's, I would say that. Mr. Willis, you have anything for that?
The one thing I'm seeing in almost every podcast is relationships are the most important part of all the businesses. You have to have those relationships, and being a part of the club, I believe, is really going to help with that as well. And one thing that I was wondering, and you explained the BRRRR method, that was perfect. You said that the hard money lenders, you're going that route originally because they're going to be more lenient, but they're also going to charge you more with the interest rate, I think you said up front. Is that true?
Yes. So interest only, so I don't know I think I know where you're going with this. Yes, but you're not paying it long. So ain't like you're paying a lot of interest over time. You're just paying a lot of interest compared to that period of time. So again, it's within 2 years they want their money. It's not like you have a 12%, 50% interest rate for 30 years. Nah, that's a lot. You're paying over time. Yeah. So you just want to get the hard money lender, get the property, get the asset, because it might be challenging to get, like you're saying, we're talking about this now, it might be challenging to get traditional financing for an asset right now. That's why you want to go to other people for creative financing. So, you can have some leverage. So I think is that where you were going with it? The expenses of interest? for a period of time.
Yeah, when you look at the interest on your loan, I remember when I bought my first my first home, and it was maybe close to 5% interest rate. But over 30 years, you're ending up spending close to double the amount of what you borrowed, right? Over a period of 30 years. However, if you're doing a high interest loan over a period of 2 years, you're going to spend less in interest, maybe over 30 years than you would over 30 years. But at the same time, you are responsible for paying that back in the short amount of time. So you need to make sure that, like Ronald said, you're doing the right number of, the right kind of research. Because if you buy in an environment where the value of the home will go down because you didn't know that a jail was being built, you didn't know that there was a nuclear plant nearby, or any of those kinds of things, then you're going to be at risk of not being able to pay back the after value market, or get that refinancing for the after rehab, I think you called it, after rehab loan.
Yes, sir.
Yeah, so it's a big risk if you don't do your research.
Correct. Exactly. That's what's the point about those investment clubs. You're dealing with mentors as well that have been there, that can teach you what places to go, where to really penetrate your energy at. So that's really vital.
Yeah.
Is there anything you'd like to add, Ronald?
Oh no, you've covered it. He's covered it. I am. I have never used a hard money loan lender. I've gone only the traditional FHA, conventional loan method, and I have done some creative financing, but not the hard money way. Okay.
And I believe that kind of saves you interest in the long run, or a little bit of stress, because it's a lot of stress, I bet, to have a $200,000 loan these days that's due in 2 years.
Yes.
Yeah.
Maybe I want to mention this. There is a term, I think they still use it, balloon payment. Are you familiar with that, Mr. Solomon?
Yes, and most hard money loans are like that. They're balloon payment at the end of the 2 years.
So that means what? Explain what that means.
Basically, you pay all the money up front. You might pay the interest, the monthly payments on interest, but you'll pay mostly the rest of the amount, mostly the principal, at the end of that term.
And I think new investors should really understand the definition, as I said earlier, equity, you mentioned interest, and principal. And that is super important and included in any of these loans. At least the loans I've been associated with. I do not know, not speak from experience about the hard money loan, but is there an insurance factor included in that loan? So for instance, if you get a traditional loan to buy a house, they're expecting that mortgage to contain an insurance payment in the mortgage. You follow me?
Correct. Yes. All that be in the contract. Yeah, I understand, Ron. Yep. Mm-hmm.
So don't exclude that, because that's very important, because they want to know if you should default, if there should be a fire, flood, some condition, mother of nature. What protection do they have, insurance-wise? So always include that factor, the insurance, to be included in the cost of the loan. That's what I want to say. Okay?
Thank you. Appreciate it.
Yeah. So we want to move on, Keisha? Go ahead.
That's excellent advice. And I was wondering, when we were talking, you just mentioned a lot of things that could go wrong. I mean, with the natural disasters, your health, anything could go wrong. Right. What are things that you usually plan for when you're about to take on a real estate project, or things that you actually can plan the risk mitigation for?
Well, from the bank point of view, loan officers, I'm not too sure about underwriters, and investors should know the role of an underwriter. So banks usually look at closely how much reserve money you have. And there is a ratio that discusses if you borrow an X amount of money, you should have an X amount of money in reserve. I think there's three times not three times the loan, but a certain qualifying number that if you fail, if these disasters these unforeseen circumstances comes about, you have enough money in reserve to deal with that, to ensure that you don't fail. For instance, as a landlord, let's say I have a rental for $1,000. I want that prospective tenant to have 3 times gross. His or her income should be 3 times the rent gross. So that's designed so that that person can not just pay the rent, but they has money set aside for other things because of his income. So that's part of the qualifying factors that helps buttress failure for that tenant. And in the other loan categories, they looked at that also. How much, as Mr. Solomon said, money do you have in your, and he called it, and it's real term, how much skin in the game money do you have to buttress any kind of failure, any kind of disaster, any kind of unexpected circumstance. So that ratio may differ in different financial institutions. It may differ with Bank of America as compared to a CQ, which is a credit union, or a MEQ, or Navy Federal, or APG. They all have their qualifications of how much backup money, to put it simply, do you have in your bank that would encourage them to give you a loan. Yeah. I want to say this. For instance, Navy Federal, depending upon your credit card balance, they have said to me, okay, because of your credit card balance, we'll give you $1 million loan. $1 million. So, but I don't use it. I don't use it until I find a property or business venture. They're not going to even question the business venture. Is that 800 plus credit score is enough, and my history with them is enough for them to have it ready, for me to have it, for them to have that $1 million. All I have to do is sign a check. They even send me the checks. So that's a great position to be in. But it took me a while to get in that category so that I can see a opportunity and then use that money and not pay for that loan until I use it. That's definitely a strategy. That it's called a line of credit. And I'm sure you've heard that before, a line of credit. But what is that buttressed against? It's contingent on the value of one of my other properties. So if I mess up, if I fail, they have something to go back on. They have something to say, hey, you miscalculated. Now we're going to take some of your collateral and the other properties that you have to make sure we get our money back, Mr. Willis. Follow? So having that kind of cash on hand or a line of credit is part of the strategy of my creative finance. It may work for somebody else, may have a different, as Mr. Solomon said, hard money is one way of doing it, but another way of doing it is what I just described. Having a collateral, waiting for you to invest in the opportunity and not paying for it. I mean, this loan I'm talking about, it have a 20-year cap to it. It does not, they won't take it away from you until 20 years from now. And that's what's Navy Federal. And so and that's from that span of 20 years, you can just be, looking for the opportunities. But it's up to $1 million. And if you want more, you can ask for more as long as your credit history with them is outstanding, phenomenal. You with me? So the key again is using somebody else's money to get what you want.
Love that. I love that. And Shepard, do you have any examples of how you've mitigated risk in your business and in your real estate journey?
I mean, well, just like Mr. Willis was saying, make sure you have reserves, because tenants might not always pay, to be honest with you. And tenants can also mess your stuff up and they might not have money to pay you back. And if you want to keep your business operable, you're going to have to eat that. So it's always making sure you have reserves. And like I say, do your due diligence like we were talking about before. Make sure you know what area it is, if it's declining, if it's improving, you got the right insurance. If you're going to use a property manager, if you're going to get rented out, make sure as a property manager is credible, because property managers basically tell you information that you have to just deal with. They're face of the tenant, but you still have to make decisions. So if you're not having a good property manager, they can put you in a tough situation, especially if the tenant's trying to communicate with them and they're not communicating back. So I'll say make sure you have the proper resources over time. And like I said, the investment clubs help you with a lot of information, because a lot of us, especially people who just, employee mind people, and your parents employee mind people most of the time, you don't really know what you're doing in the business sense. So you're gonna need to have mentorship, education of how to run a business, how to handle situations, how to work with the city, the government, those things, banks, like Mr. Willis is talking about. How to leverage those things. You need knowledge for that. That means you be around people who know what they're talking about. So that investment club is very vital, and especially for new investors to be successful. So that's how I'll mitigate risk.
I love that. And you've dropped so many gems there. And if you wouldn't mind taking it back, because you've mentioned investment clubs quite a few times, when you're looking for investment clubs to join, what are the values and things that you're looking for when you're joining a club?
Well, you will look at one that's around your area, what area you want to invest in. And then I'll say, build relationships with people. So you want to know they have a diversified of professionals. They have lenders. They have other investors, wholesalers, those type of things. You want to network with different people. When you network with different people, you can leverage a lot more, and you're more diversified in your thinking. You want to also finally have partners. Partners can help mitigate a lot of risk. It's not just you investing into something, you got someone else investing with you. So those are good strategies to when you're trying to find investment clubs. But again, you have to go and just search something and kind of get involved and see how the rhythm is. It takes time, to get, build relationships and see how it is. But most of them are like the same. Just to let you know.
I love that. And one of the things that I'm really wondering about is partnerships. So I've seen the shows. Partnerships can go good and partnerships can go bad. What are the red flags that you're looking for before you decide to go into business with another business partner when it comes to real estate?
Good question, Keisha. If I see consistency, if you're not consistent answering the phone and all that, I look at it like, okay, how I'm gonna work with you in business. If you're not dependable, and its main thing is communication. Some people who are investors, you want to see if they're going to do what they said they're going to do. They're going to respond to you by this time. They're going to send us information by this time. If I'm seeing I have to keep reminding you about stuff, I'm like, okay, I'm gonna have to keep doing it over and over again. So that kind of gets me where I don't want to work with them. And I see people who have integrity. You have to, if you're trying to make shortcuts in this business, you will get hit. I wouldn't want to work with nobody who's trying to get easy money, easy profit. I want to work with some people who actually have practical, logical knowledge and know how to treat people right, know how to work with people, because if you work with the right people, you're not caught in tough situations. It might take longer, but it's the right way of doing it, and you can have a sustainable business that way. So, it's about working with the right people. And again, that takes time. But I'll study your consistency, like just to answer your question. I just also can, I analyze how you treat people, how you treat me. Are you cordial? Because I know if you don't want to build relationships, we can't really leverage certain things. So those are things I will analyze.
Those are great things to analyze when it comes to working with somebody, and something to keep in the back of your mind. If you notice that, hey, this person isn't reliable, maybe that's not the right person to go into business with. And even if you recognize yourself, hey, I'm not reliable, maybe you don't go into business with people as well. So this is good. But I also heard that it's good to work with people that are strong in your weaknesses, right? So maybe you're not good with scheduling. So you work with someone that's good in scheduling. You try and bounce things up. Maybe you're not good with sales. So maybe you find someone that's good with sales while you go and do the renovations, those kinds of things. So it's a partnership where not everybody's exactly the same, but they're all bringing the strengths that maybe the other person is weak in or doesn't enjoy doing.
Yeah. And one thing to add, Keisha, I know, especially with new investors, you feel comfortable sometimes when you're new working with people that you already know, like friends. And if that's cool, but you have to have a thin line between personal relationship and business relationship, and you can't mix the two. And if they mix the two, I wouldn't work with them. They gotta know how to compartmentalize it. This is business decision, but we still friends, but we got to take care of business. So you have to analyze that too if you want to work with people that you know, because if it causes of a business situation, it can affect a friendship. So you have to be aware of that situation if you really want to work with someone that like your family member or a friend you've been knowing for years, and everything like that. But make sure you keep things separate. Don't mix it. So that's one thing I got to add for that.
I think that's a great idea. My mom watches judge shows all the time, and the money and the friendship is not always a good thing to mix because that can go wrong very quickly. Ronald, do you have any red flags that you look for, or green flags? Since we already did red flags, do you have any green flags that you look for when you're working with a partner?
Well, I have never worked with a partner on a house other than Mr. Bank. Mr. Bank. So there's nobody else on my deeds than Ronald A. Willis. And same with the ground. Many houses are sold without the ground. So you have to contact the bank, and hopefully they will give you the person who owns the ground. Two separate issues. Not all houses are purchased in fee or at the same time.
Can you explain that? I have no idea what we're talking about. What do you mean you don't own your ground that your house is on? What is that? What?
Well, in Baltimore City, that's what I can speak of. You can buy a house with a separate ground rent. Somebody else owns the ground, and somebody else owns the house. So when you purchase the house at settlement, before you go to settlement, of course, you want to ask that real estate agent, does the house come with the ground? And as you ask that house, you're stuck with the ground. It's not that much every year, but it's still, you don't own the ground. And there's a lot of reasons for that, because it goes way back in history where the colonial people captured Baltimore, let's say, and owned certain parts of the ground, even though they lost the war. St. Mary's County, Calvert Street, Charles Street were all named after capitalists of another country. So although they won the War of 1812, before they left this country, they actually owned the ground. So you have to ask that intelligent question. Thank you, Mr. Real Estate Agent, for showing me this beautiful home. That looks great. But you have to ask the question, does it come in fee? There's another term that also means you buy the house with the ground, but you have to ask that question. That's a real question. Okay? Many of the houses that I purchased, I didn't purchase it with the ground. The bank was fortunate enough to tell me who owned the ground. So years later, I bought the ground. And sometimes the owner of the ground came to me because they were in a depressed situation and they wanted to sell the ground because they wanted to pay off a divorce or pay off a major medical bill. So yes, the house and the ground is two separate issues. Okay?
Is it possible, this is just me thinking out of the box because you're doing a creative financing, is it possible to just go around just buying ground from other people's houses now? And then they pay, you can change their rent on the ground?
Change their rent? I don't know the answer to that question. I do not know if you can change the amount you pay for the ground. It depends on who owns the ground and how desperate they are to sell the ground.
If you own the ground, this is just me wondering because I've never heard of this. So you bought a house, you didn't own the ground. Did they come and mow your lawn for you?
No,
Like, just walk around on your
they just wait for the ground rent check to come to them. And so
and you're still responsible for the upkeep.
That's correct. Isn't that
That
crazy?
sounds like the best passive income I could think of.
There are people who buy grounds. Listen at this. Hey Google, explain ground rent.
Here's the definition of ground rent. Rent paid under the terms of a lease by the owner of a building to the owner of the land on which it is built.
Okay, so two separate issues. So that's an important question to ask. Whether you're dealing with any conventional loan, any hard money loan, you must the research. So that's an intelligent question to ask.
It reminds me a bit of the condo fee. So you're buying a place inside of another place, so you have to pay a fee to be inside that place. Okay.
But unlike a condo fee, there is no maintenance required on the person or persons who own the ground. No maintenance on their part at all. It's a historical transfer of the house and the ground over years, many even centuries. It goes back to somebody was smart enough to buy the ground, and then a builder came in later and built on the ground. So that's a real fact. That's how it works. So, any more questions on that issue?
No. Did you want to add anything, Shepard, about that, or things that you found, like little hiccups when you're buying a home that you wouldn't have considered as a real estate investor?
Just so the term I think we were trying to say, Ron, when you basically own the whole property, is the fee simple.
Fee simple. That's it. Fee simple.
Yeah,
that's what fee simple means. You're buying the house and the ground at the same time, right?
Yeah, correct. You have everything's yours.
Everything's yours. So that's important. So I want to share with you this. I mentioned credit unions. I mentioned banks, and each of them have their own buzzwords that will convince the loan officer to talk to the underwriter that helps the loan go through easier. And so I think it's important for investors to know what is expected from the loan officer and how he reacts or she acts with the underwriter, because they're scrutinizing your credentials. They're analyzing it to ensure that loan doesn't fail. So there are certain terms that you should know in this industry that helps with the loan, that helps with a legitimate answer to the loan officer and to the underwriter, so they can say, oh yeah, I understand that now. Can I give you an example?
Absolutely.
Okay, so I'm insured by a unique insurance company, and that company has this symbol on 5 of the 10 of my houses. I should see that or not.
Put it in front of your face like you did last time. Yeah, there you go. The handshake in 1794.
Right. So the company's been in business since 1794. It's difficult to explain to loan officers and underwriters, how can they do this? How can they not charge you a monthly homeowner's insurance? And how can this company, Baltimore Equitable Insurance, not charge you a monthly fee for your homeowner's insurance? Because they have a unique way of analyzing your loan. And so think of the thousands of dollars that I've saved. I've been with them over close to 30 years. And every loan that I've had did not include a home insurance component. I'm just throwing out a number now, $200 a month included in your mortgage just for the insurance. Okay? And that means that you don't pay that. You're the homeowner, home buyer. You don't pay that insurance, but you pay it up front because they come to your home, they meaning Baltimore Equitable, and evaluate, appraise your home and say, this is going to cost $3,000, this is going to cost $4,000 up front. But after that, you don't pay that monthly fee. With me? With me so far? You don't pay that monthly fee, they pay it. They pay it yearly. They pay it yearly. So if this thing, multiplying that times 5 years, 10 years, 20 years, 30 years. And the good part about it is, whenever you decide to sell that property, that money that you put into it is all yours, with the exception of any interest. No other insurance company in the United States, except Philadelphia, has that particular clause that when you keep that insurance for 3 days, 5 days, 10 years, 100 years, whenever you decide to sell that property, that money is always yours. Now, this is not a catch, but property, if it's a sound piece of property, escalates in value over the years. So Baltimore Equitable may come and say to you, okay, you bought it 10 years ago, it was only $50,000, but now it's worth $150,000. So you need to bring up that insurance to that level, to replacement level. All I'm trying to really to replacement level. So it may cost you $300, $500 for that 1 year, not year after year after year or month after month after month. So you have to be able to explain that logic to a loan officer, who explains it to a underwriter, so they can say, now we pictualize that this person, based on their income and their history of working, can conceptualize all this and say, yep, that makes sense. He's not going to have this $200 a month added to his mortgage. You see, so it's hard for banks to understand that because it's so unusual.
Yeah,
It's so unusual. See, so only Philadelphia contributionship in Philadelphia, good old Ben Franklin, you know who he was, he invented this concept. And only in Baltimore, Maryland is it accepted. Not in DC, not in Chicago, no other states have this. So it's a matter of explaining to your loan officer, who explains to your underwriter this connection, relationships, you mentioned that, how important that is. So I've done it. When I moved here or where I live, I never heard of this. There's a plaque that the company gives you, thick plaque. It's called, they look just like this, and has the two hands clasping. And I'm sure in 1794, it was designed for the rich. But as centuries has come forward, they have they've tweaked their policy. So if your home is not, I wouldn't say, if your home doesn't meet their standards, you don't get this policy. You see? So I'm not interested in inner city property that is going to not be accepted by them. All 5 of my 10 properties have this, 1794. But the other 5 don't, because they only go up to 5 properties. See? So that's all a part of creative financing in a way, because you're building.
You're saving. I was doing the math in my head. If you're saving $200 a month over 30 years, that is close to $75,000, I would say, close to, so that's a great deal over time. Think of what things you could do with that kind of money. You could buy whatever you feel like, really, with an extra 75 in your pocket. So I wanted to ask Solomon a question next, and that is, because you're the mentee of Ronald, and this is so exciting, what did Ronald teach you that you really especially appreciate?
Mr. Willis taught you how to build relationships, to be honest with you. And he taught you the practicality of how to run a business. Sometimes, we get the theoretical knowledge, but when you're working with Mr. Willis, when I was younger, I would go to the properties with him, see how he interact with people. I would do work with him, when he's doing renovations and trying to get tenant out, move another tenant in. And you can kind of see, okay, if I'm going to get involved in this business, what I'm going to have to do to get involved, what price I'm going to have to pay. He was real good at teaching from a practical level, very good in teaching.
I feel like we've covered a lot of different things, especially one of my favorites is how you build the relationships, joining clubs. Probably you need to reach out to Mr. Willis and ask him to be a mentee, and also how to deal with banks and also hard money lenders. Is there anything else you feel a beginner should do when they begin to get into real estate?
Well, having developed good investigative skills. I'm from the inner city, born and raised. And when I moved out here in Hamilton, I live in an individual house. And what I'm trying to share with you is I began to ask questions, my neighbors questions. And that's how I learned of Baltimore equity. My next door, my neighbor across the street from where I live, he was a different ethnic persuasion than myself. And I wasn't shy. I was friendly and firm and convinced my neighbors that, yes, I'm the second black to move in this neighborhood, and I'm going to keep up my neighborhood just like you. And I'm not bragging, but I think I have the best house in the neighborhood, best looking house in the neighborhood. There's been no complaints. So I think having a friendly personality, candid personality, helpful personality helps in your interrelationships with people. And maybe that's why at Morgan I majored in sociology, because I love solving problems that people have. And so I translated that into solving home problems where, hey, it's wintertime, it's so much snow and ice in our driveways. Can I help you? Can I do something to carry your bags as a senior citizen? Participate with the people around you. You don't have to be in their house every day for a cup of sugar or a food or anything. Just be interested in the American dream. And that American dream for me was a decent home. And if I can add to my neighbor's decent home in some way, hey, you need a screwdriver? You need a pair of pliers? Come on, I got this for you. And so I think that outgoing attitude in everything that I've done, private and non-private, government included, being at what helps you generate opportunities is your inquisitiveness, your ability to be learned, to be helpful. You see a person struggling, you help them. You see a person wondering how to do something, and I think the key word is sir, can I suggest something to you? Ma'am, can I suggest something to you? Instead of do this, do that, do this. I think your approach and your tone has a lot to do with your success. If you're an introvert, well, I'll leave you with this. So this is some of the things I'm going to leave you with. There are three kinds of people. Ones that watch what happens, ones that ones that watch what happens, ones that wonder what happens, and ones that make things happen. And I think you've got to ingrain that, what I just said, into your mind if you want to evaluate your own success tangibly. It's all right to say, well, I could have done, I should have done, or if I had that obstacle I could have overcome. I think when you evaluate your success in a tangible way with a clean record, and Ronald Willis has a clean record, not a tenant of 40 years ago, today can say he volleyed, she volleyed. None of them have taken me to court for any kind of violation other than they didn't pay the rent, failed to pay the rent, which has nothing to do with my part of the business. They signed the contract to pay their rent. Now, as a good landlord, I can weigh their circumstances. As a private landlord, I can have gray areas for them to recoup their layoffs, their difficulties. I can extend their rent payment. I can work with them in certain ways. all up and above board. So you have to be proud of your history. You have to have no secrets in your business. That the IRS, CIA, or anybody else can say, we can get him. We can convict him because you have a clean record. So I want you to really digest what that means. That has been an integral part of my success. And I am not a business major. I'm not an MBA, So I just want to share that with you, Keisha and Mr. Solomon, my mentee. That has been part of my DNA, to be candid with my business transactions. And that has led me to the success that I've had. And Mr. Solomon can speak to his own success, but I've shared that with each mentee. If you got something to hide, don't be in this business. If you want to be slick, don't be in this business. You may not get caught right away, and expect difficulties. Expect tenants who will renege on their responsibilities for a variety of reasons. So you have to have that ability to deal with that in such a way so that you don't fail. In the 12 houses that I've had, 10 houses that I have now, I have not been late on a mortgage payment 45 years. I've had to ask the bank, hey, here's something I want to say. Mr. Bank, instead of the mortgage payment due on the 1st, can I make it the 15th without a late fee? Oh, yes, Mr. Willis. All you had to do was ask. And many people don't know that. They think, okay, yeah, well, you're going to be late. But if you have a good history with the bank, they'll say, well, you know what? To make sure you don't fail, we will grant you the mortgage payment due on the 15th. And look what that does for the landlord or the borrower. It gives him wiggle room to get his finances together without a late fee, without it marked against his credit score. And by the 15th, the tenants have paid you by the 5th, let's say, but your difficulty of paying the mortgage payment is within that gap of the 5th to the 15th. That saves a lot of people from failing. And all you have to do to the bank is what? Ask. Ask, nicely. And I've experienced that, not just with the bank, but with their credit cards. If you know you're going to be late, oh my goodness, I'm so embarrassed. I shouldn't ask. I don't know if they're going to do this or not. Just ask and be legitimate about it. And they will usually say, well, we'll give you until the 15th. We'll give you until the 20th without what? A late fee. So I don't want to ramble on. I think
I do get your drift because I do this all the time. I think everything is negotiable. So I will call the credit card company up and say, hey, I didn't mean this. Can you change this? And can you up this? Can you lower this? And they're usually pretty open to it because it's all about communication. Is really all it takes. I've heard stories of, landlords, one of their tenants actually called and said, something happened. I cannot pay my rent this month. I need an extension or something like that. And the landlord was so happy that they didn't just bounce on their rent like most people, that he gave them 6 months. It's like crazy what can happen if you just communicate. So I know we were in the middle of communicating with Shepard. Is there anything else you'd like to add about Mr. Willis before I give you your next question?
I know we're talking about Mr. Willis, the practicality of running the business. He also taught you how to think about situations. He'll ask you questions and say, you got this tenant here, you got this person here, but this person is doing this and they've been with you for a while. How would you handle that? So he'll make you think about, okay, all the parameters of everything, because you're going to have to make these type of decisions when you in their seat. You have a person who's been with you for probably 10 years, but they've been late on one rent. How are you going to work that out? Or 2 months in a row, but they've been with you for a while. So they had credibility. So he'll tell you to make decisions like, how would you handle it? How would you negotiate that? How would you deal with this situation? Which we need that. We need really mentors and other people challenging our young how to look at situations and how they will deal with it if they were in their shoes. And he also told you know how to spend your money. You know, like you don't gotta spend money on Jordans and stuff like that. I mean, that's not bringing money in your pocket. He taught you put money in assets. You know, put money where it's going to make you money. Put money where you get the tax advantages at, and not stuff that's going to just take money from you. You know, you don't need a big old BMW and all this other stuff. Even if you can probably afford that, you're going to get used to it after a while anyway. So he was like, hey, you can live a simple life. You don't need all that stuff. You just need the things you really need. But you let your assets, if you do want to get all luxury, you let your assets pay for your liabilities. That's a strategy. You put money towards your assets. When your assets are making money, passive stream of income, then you can afford all those nice things you want without necessarily being in a bind. So he taught you how to use your finances as well. So I'm really appreciative in my life. I wouldn't be where I am if it wasn't for him, because he really put a lot into me and a lot of other people too. So you don't have to, but he's always there and he wants to help out, you know, his community. So I appreciate it.
Thank you, sir. You're almost making me cry.
Oh, no, that's really good advice. I mean, you're really a gem, Mr. Willis, for doing this. And I want to also add that all three of us are Morgan State grads. I think I forgot to put that in there. So, Shepard, you're class of 2011 in business, correct? And Mr. Willis, which year again?
1973.
73, and I am 2003 electrical engineering degree. So this is so exciting that we're all here together and sharing the real estate journey. I'm glad you guys were able to stick with it. I was a real estate agent for 1 year, and that was enough for me. I want to ask one last question of Solomon. Is there anything that you'd like to share for a beginner before they get started, or anything you'd like to share about what you do before we close out?
Okay, so I know I came in late a little bit. Sorry about that. I was trying to get everything set up. So appreciate you guys working with me. It is other ways of creative financing I do want to share a little bit, because I also did one. You have one where you can do seller financing. Another one is subject to agreement. Okay, so I'm just going to get a little bit about seller financing. Most sellers, they already have equity in their home. And they don't mind waiting for their money. They can, you know, do a promissory note with a buyer, and they can basically dictate the terms of when their buyer pays them and how they're going to pay them. So, you know, that's the one way of doing it. But a buyer, again, can get into properties without having to go through traditional financing. They can just work with the seller. The seller will be the bank in this situation. Subject to financing is this. Basically, for a seller, it's hard to sell their home. Probably a tough economy. Probably the interest rates are very high sometimes. Just been on the market for a while. It's some buyers will say, hey, I'll give you an option fee, probably $10,000, $15,000, and I'll pay your mortgage for you. What you do in return is you just transfer the deed to them. But for the seller, the mortgage is still in your name. So it's a riskiness, because it can be a due on sales clause where if the bank finds out that the deed has changed, they can ask for all their money up front. Some buyers have ways of going around this where they'll just, if that does happen, they can just do a lease option agreement to the seller and basically just do a sublease. Because most of the time when these buyers buy these homes, they're just renting it out. But those are two good ways of buyers getting into homes without having to go through banks. They kind of work with the seller directly. All right. Anything that, so those are the ways I was trying to say earlier, but I know I came late. Anything to add, just, I do appreciate you, doing this. And I think a lot of people just need more information on how to really run a business, because we don't get taught that stuff in school. If you're not an entrepreneur and if you're just an employee, you're in a situation where you're depending on jobs to kind of help your lifestyle. But we see in this economy that you can lose your job anytime, Right. And if you don't have other streams of income or a place where you're building an institution to control your stream of income, you can be in some tough situations, especially when you get older and when jobs want to let you go when you're older. So I really think entrepreneurship is something really key that we need and needs to be communicated throughout the whole community. And these sessions are really great for that. So I do appreciate you, Keisha, for allowing us on this podcast and sharing our knowledge.
Yeah. So I have to meet a technician at one of my properties in a few minutes. So are we almost ready?
We
Talk?
are almost ready. I was going to read my closing statement, but you
Okay.
can drop off if you'd like to. Before we close, I want to thank each of you for coming out today. This has been really, really helpful. Like Solomon said, to anyone that is interested in entrepreneurship, interested in starting in real estate, you have learned so many different things that I'd never heard of before, especially the hard money lending, and also really good just key values such as the relationships, having that outgoing personality. So again, I want to thank you guys for coming. This is the Mystery to Mastery podcast. So you will be getting your own webpage. Mr. Willis already has his, mysteryai.net/Willis. And then I will have a mysteryai.net/Solomon, where this episode will be actually featured, and also on Spotify as well. I'll reach out to you guys with that information. And if you want to get in contact with Mr. Willis or Mr. Solomon, their information will be available on those web pages. In addition, we are going to create an ebook and workbook to help you with your journey as well. So those will be available as well. Thank you again. This was phenomenal, honestly, and I will be in contact with both of you in the future to share what the website is, make sure that everything is correct. So thank you guys. Oh,
Thank you.
I almost forgot. If you like this episode, please like, comment, share it with someone else that thinks that may enjoy it as well. And again, this is Mystery to Mastery podcast, where you go from mystery to mastery. Before I let you go, if today's conversation inspired you and you have something to share with this community, I want to hear from you. Whether you want to be a guest on Mystery to Mastery or you want to get your brand in front of this audience as a sponsor, the link is in the show notes. Get on my calendar and let's talk. See you next time on the Mystery to Mastery podcast.